Hey everyone, welcome back. We're doing a deep dive today into Warren Buffett's 2012 letter to Berkshire Hathaway shareholders.
Yeah, this letter's really packed with insights. Even if you're, already a Buffett fan, I think you'll find some interesting stuff in here.
Oh, for sure. And what's really cool is we actually have some listener questions about this specific letter
Yeah.
that we're going to use as a bit of a guide.
Yeah, it's like they've highlighted the parts they think are most crucial, so we'll dive into those.
Exactly. It's like a treasure map leading us right to the good stuff.
Exactly.
So we're going to use those questions to really dig into those nuggets of wisdom that even seasoned Buffett fans might miss.
Yeah, should be fun.
All right. So one of the first things that really struck me about this letter is that Buffett calls 2012 a subpar year.
Uh,
Now, on the surface, that seems crazy because Berkshire had a gain of $24.1 billion. So what gives?
yeah, that's a head scratcher. Unless you understand Buffett's long-term focus. I mean, he's not just looking at year-over-year gains.
Right.
He's obsessed with intrinsic business value, and he uses book value as a way to kind of measure it.
Right.
His goal is to beat the S&P 500, not just in one year, but over the long haul.
So in 2012, Berkshire's growth didn't quite outpace the S&P 500, and that's why he wasn't exactly thrilled, even with that huge gain.
Exactly. And what's really interesting is that he also mentions that Berkshire actually tends to perform better in down markets.
Yeah.
It's a good reminder that even the Oracle of Omaha doesn't hit a home run every year.
Right.
Steady long-term approach. That's what really matters.
Right. He's all about setting those realistic expectations.
Yep.
Okay, so let's talk acquisitions now. 2012 was a pretty quiet year on that front, at least in terms of mega deals,
Right.
which might be another reason he felt it was subpar.
Yeah, he did hint at a big one coming, though, in early 2013.
Oh, yeah, and it turned out to be a whopper. The acquisition of H.J. Heinz,
That's right.
a classic Buffett elephant.
It is.
What made this particular elephant so appealing?
Well, the structure of the deal is really interesting. Buffett partnered with Jorge Paulo Lemann, a brilliant Brazilian businessman.
Okay.
Each put in about $4 billion for common equity,
Wow.
with Berkshire adding another $8 billion in preferred shares that pay a 9% dividend.
Okay.
What's fascinating here is this partnership really highlights one of Buffett's key principles, finding the right people to work with.
So in total, Berkshire invested about $12 billion in Heinz,
That's right.
which was a huge chunk of his 2012 earnings. I mean, the scale at which this guy operates is just mind-boggling.
It really is, and it shows how he's willing to go all in when he sees the right opportunity and the right partner.
Yeah, it's not just buying companies. He's buying into the people running them.
Absolutely, a huge part of his success.
For sure. Okay, let's move on to what Buffett calls the Powerhouse Five, Berkshire's 5 most profitable businesses outside of insurance.
Yeah, this guy's crushed it in 2012.
They did over $10 billion pre-tax in earnings.
Yeah.
So just give us a quick rundown. Who are these Powerhouse Five?
Okay, so we've got BNSF, the railroad, Mid-American Energy, the utility giant, Iskar, the Israeli metalworking company, Lubrizol, the specialty chemical company, and Marmon, a collection of manufacturing and service businesses.
Wow, that is quite the diverse group.
It is.
But they all share some key characteristics, right?
Yeah, strong competitive advantages, great management teams, and consistent earnings.
And here's a detail that I think really highlights Buffett's discipline when it comes to allocating capital weight. 3 of those powerhouse in those. 5 were acquired entirely with cash, and 1 required only a minimal amount of share dilution.
It's pretty incredible.
Yeah, he's not just buying any business that comes along. He's being super selective and really looking for those deals that create, real value.
Right. And he's not afraid to pay a fair price for a great business.
Right.
He understands that in the long run, it's better to own a piece of a wonderful company than to overpay for a mediocre one.
I love that. And on top of those massive powerhouses,
Yeah.
5 companies, Berkshire also acquired 26 smaller businesses in 2012.
That's right. He calls those bolt-on acquisitions.
Right.
And they're a key part of his strategy.
It's like he's building an empire brick by solid brick.
That's a great way to put it.
Okay, it's time to talk about the engine of Berkshire's growth, insurance.
Okay.
Now, this is where things can get a little complex, especially for folks who aren't familiar with the concept of float.
Yeah.
So can you give us like an ELI 5 on what float is and why it's so important to Berkshire?
Sure. Imagine you run an insurance company. You collect premiums from your policyholders every month, but you don't have to pay out claims until something actually happens, right?
Right.
That money you're holding between collecting premiums and paying claims, that's called float.
So in Berkshire's case, that float was a whopping $73 billion in 2012.
Wow.
That's a lot of cash to play with.
It is.
But if I remember correctly, float is treated as a liability on the books, right?
You're right. On a balance sheet, float shows up as a liability.
Yeah, it seems counterintuitive that this massive pool of money would be considered a liability.
Yeah, well, Buffett argues that that's actually a misleading way to think about it. He sees float as a revolving fund that Berkshire can use to invest in other businesses.
Okay.
And if it's cost-free and long-enduring, as he believes Berkshire's float is,
Right.
then its true value is way less than what's reflected as the accounting liability.
Okay, so as long as Berkshire continues to underwrite profitably, meaning they take in more in premiums than they pay out in claims,
Right.
that float is essentially free money that they can use to invest.
Yeah, it's like a giant interest-free loan that keeps on giving.
That's a great way to put it. And that's why understanding float is so key to understanding Berkshire's success.
Yeah, it's not just about picking stocks. It's about understanding entire business models and how they generate cash that can be reinvested.
Right. This letter really gives you a window into how Buffett thinks about these things.
It does.
Okay, so we've got this massive pool of float, which is essentially free money. But of course, it doesn't just magically appear. Berkshire's success in insurance is driven by some of the best managers in the business. And Buffett specifically highlights 3 all-stars in this letter.
Yeah.
Ajit Jain at Berkshire Hathaway Reinsurance Group, Tad Montross at General Re, and Tony Nicely at Geico.
3 legends.
So what can you tell us about these insurance legends and what makes them so successful?
Well, each of these individuals exemplifies the 4 disciplines of sound insurance underwriting.
Okay.
Understanding the risks involved, assessing the likelihood and potential cost of those risks, setting a premium that guarantees a profit, and most importantly, having the discipline to walk away from a deal if you can't get the right price.
And that last part's so important, and it's something that a lot of insurance companies struggle with. They get caught up in competition and end up chasing bad business just to keep up with everyone else.
Exactly. That's a recipe for disaster in any industry.
Yeah.
But it's especially dangerous in insurance.
Right.
These 3 leaders understand that they're not afraid to say no to a deal if the terms aren't right.
So let's delve a little deeper into each of these insurance all-stars. First up, we have Ajit Jain at Berkshire Hathaway Reinsurance Group. Buffett has called him a jewel, and his track record really speaks for itself.
It does.
So what's his secret sauce?
Ajit is known for insuring risks that others wouldn't even touch.
Like what?
Think of it like this. He's the guy you call when you need to insure a skyscraper against an earthquake or a satellite launch against failure.
Wow.
He's willing to take on these complex, high-stakes risks, but he does it in a way that consistently generates profits.
That is pretty amazing. And Buffett says that no other insurance CEO comes close to what Ajit has achieved.
He's one of a kind.
He built this business with $35 billion in float and a long history of underwriting profits. And he did it all starting from scratch back in 1985.
That's incredible.
Incredible. Okay, next up we have Tad Montross, the CEO of General Re, another reinsurance powerhouse.
Okay.
What can you tell us about him and his leadership style?
Tad is all about sticking to those 4 disciplines of sound insurance underwriting we talked about.
Okay.
Very disciplined and analytical, and he's not afraid to make tough decisions. He's also a great communicator, and he's built a strong culture of collaboration and trust within General Re.
You know, one of the things I admire most about Tad is his focus on long-term value creation. He's not interested in short-term gains or flashy headlines.
Right.
He's building a business that will be around for decades to come.
Exactly. And that long-term perspective is perfectly aligned with Buffett's own investment philosophy.
Right.
They're both playing the long game, and they understand that the best results come from patience and discipline.
Absolutely. And finally, we have Tony Nicely, the longtime CEO of Geico.
Ah, Tony.
He started with the company at age 18
Wow.
and worked his way up to the top job.
That's the kind of story you just don't hear anymore.
You don't, it's incredible. And it's a testament to both Tony's talent and his dedication to Geico.
Yeah, under his leadership, the company's been gobbling up market share without sacrificing underwriting discipline.
It's impressive how he's been able to maintain Geico's focus on operational excellence, even as the company has grown, exponentially. They're known for their efficiency, their customer service.
Right.
And that's a direct reflection of Tony's leadership.
And of course, who can forget the gecko?
Oh, yeah.
Tony's really embraced the power of marketing and branding, and that's helped to make Geico one of the most recognizable insurance companies in the world.
Okay, so we've covered insurance, but there's so much more to explore in this letter.
A lot more.
We're going to dive into Buffett's thoughts on regulated businesses,
Yeah.
manufacturing, and even newspapers.
Newspapers.
Yes, newspapers after the break, so stay with us. All right, so we're back, and we're ready to dive into some more of Buffett's wisdom from his 2012 letter.
Okay.
So let's shift gears now and talk about what he calls regulated capital-intensive businesses, specifically BNSF, the railroad, and Mid-American Energy.
Yeah, these are fascinating businesses. They're essential to the American economy.
Right.
But they require massive upfront investments.
Right.
And operate in heavily regulated environments.
Right. It's a different game than, running a candy company or an insurance business.
Yeah.
So what are some of the key insights Buffett shares about how he approaches these investments?
Well, one of the things that stands out is his perspective on debt.
Okay.
Both BNSF and Mid-American carry significant debt loads, which might raise eyebrows for some investors.
Sure.
But Buffett explains why it's not a cause for concern in these cases.
Okay.
He points out that these businesses generate incredibly stable and predictable earnings, even in tough economic conditions.
So it's not about avoiding debt altogether. It's about making sure the earnings can comfortably cover the interest payments.
Exactly. And he specifically mentions that Mid-American is uniquely positioned to handle debt because its earnings are very recession-resistant.
Okay.
People need energy no matter what the economy is doing.
Right.
And their revenue streams are diversified, so they're not overly dependent on any single regulatory body.
These aren't your typical, highly leveraged, risky businesses.
No, not at all.
They're solid strategic investments that generate consistent cash flow. And that consistent cash flow allows them to keep investing in long-term growth.
Right.
I mean, BNSF is spending billions to improve and expand its rail network.
Right, which is essential for keeping up with the demands of a growing economy.
Exactly. That's a great example of Buffett's long-term thinking.
It is.
He understands that these industries require a different approach. You can't just, slip a switch and create a new power plant or lay down miles of railroad track overnight.
No, you can't.
These are investments that pay off over decades, not quarters.
Exactly.
Speaking of long-term thinking, one detail I found really interesting was BNSF's fuel efficiency. Did you know that they can move a ton of freight, almost 500 miles, on a single gallon of diesel?
That's pretty incredible.
It's incredible. And it highlights the, practical, real-world impact of these investments.
Yeah.
Buffett is putting his money where his mouth is, investing in businesses that are both profitable and, essential to the country's future.
For sure.
Now, before we move on, I have to ask about something that seemed a bit out of place to me.
Okay.
In this section on regulated businesses, Buffett talks about Mid-American's real estate brokerage business, home services. Why is that grouped with the likes of BNSF and Mid-American Energy?
Yeah, that's a great catch. It did seem a bit out of place.
It's a very different kind of business.
It is. Well, it was part of Mid-American when Berkshire acquired it back in 2000.
Okay.
And Buffett admits that he barely noticed it at the time.
Yeah.
It was just a few small real estate companies. But under Ron Peltier's leadership, it's grown like crazy, adding brokers and now boasting over 16,000 agents across the country.
Wow. So they're handling some serious volume now.
They are over $42 billion in home sales in 2012.
That's huge.
It is. And they also acquired a majority stake in the Prudential and Real Living franchise operations.
Wow.
Buffett sees huge potential for home services, especially as the housing market recovers.
Yeah, it's a classic Buffett move, finding a hidden gem and letting a talented manager grow it into something much bigger.
Absolutely. He's not just looking for, big splashy deals. He's also looking for those under-the-radar opportunities where he can put his capital to work and let a great manager create value.
And I love how he's always willing to admit when he initially missed something.
Right.
It makes him seem so much more human.
It does.
Okay, let's move on to the next section of the letter, where Buffett dives into the world of manufacturing, service, and retailing.
Okay.
This is where things get a bit more complex from an accounting perspective.
This section is where he gives us a little mini lesson on the difference between GAAP earnings,
Right.
what's reported according to, standard accounting rules,
Right.
and what he considers to be the true economic reality of a business.
Right.
He argues that sometimes GAAP earnings can be misleading
Okay.
because they don't always accurately reflect the underlying value of a business.
He uses the examples of IBM and Wells Fargo to illustrate this point. Right.
He does.
I remember reading that section and thinking, am I actually enjoying an accounting lesson?
Right. It's amazing.
That's the magic of Buffett. He can make even the most dry topics interesting and accessible.
He really can. And what he's trying to get across is the importance of critical thinking when it comes to investing.
Yeah.
Don't just blindly follow the numbers.
Right.
Understand what those numbers actually represent,
Yes.
whether they're giving you a true picture of the business.
So in the case of IBM and Wells Fargo, Buffett
Right.
is arguing that some of the intangible assets these businesses have, like customer relationships and brand value, don't actually deplete over time,
Right.
even though GAAP requires them to be amortized.
Right. So you end up with these non-real expenses that can distort the earnings picture.
Exactly. He's basically saying that sometimes you need to look beyond the GAAP numbers to understand the true earning power of a business.
Right.
And this is where his deep understanding of business models and competitive advantages comes into play.
Right.
He's able to see value where others might miss it because he's not just looking at the numbers on a spreadsheet.
Right. He's looking at the whole picture.
This is a great example of why it's so valuable to understand how Buffett thinks.
Yeah, it's not just about what companies he buys. It's about how he analyzes those companies and how he thinks about value creation.
Right. He's constantly encouraging us to think for ourselves, to question assumptions,
Right.
and to not be swayed by the crowd.
He's an independent thinker just like Buffett.
And he's not afraid to admit his own mistakes either.
No, it's not.
Right.
He talks about some of his own capital allocation mistakes, which he attributes to, his old habit of bargain hunting.
Oh, really?
Yeah, he says it's far better to buy a wonderful business at a fair price than a fair business at a wonderful price.
Hmm.
He learned that from his partner, Charlie Munger.
Yeah.
But even he admits that he sometimes slips back into his old ways.
It's a good reminder that even the best investors are human
They are.
and that we're all, constantly learning and evolving.
That's right.
Okay, so we've covered insurance-regulated businesses and even had a mini accounting lesson.
That's right.
What's next on our treasure map of insights?
Well, next we come to one of the most surprising sections of the letter.
Go.
Newspapers.
Newspapers.
Remember, this is 2012 when the newspaper industry is already in steep decline.
Right.
Yet here's Buffett buying up newspapers left and right.
I remember reading that at the time and thinking, has the Oracle lost it?
Right.
What's he doing investing in a dying industry?
It seemed so counterintuitive.
Yeah, it did, but it goes to the heart of Buffett's contrarian nature.
Right.
He dives into a nuanced analysis of the industry, acknowledging the challenges while also identifying pockets of opportunity.
Right.
He believes that newspapers serving tightly bound communities, especially those with a smart internet strategy,
Right.
can still thrive.
It's about local dominance, not national reach.
So he's not betting on the broad newspaper industry. He's betting on specific newspapers that have a strong connection to their communities
Right.
and a solid plan for navigating the digital world.
Exactly. He even highlights a specific example, the Arkansas Democrat Gazette, which adopted a pay model for its online content early on, and as a result retained its circulation much better than other large papers.
Interesting.
Yeah, this is where Buffett's focus on value comes into play again.
Okay.
He's looking for newspapers that are providing a valuable service to their readers
Right.
and that have a sustainable business model.
Okay.
He also talks about the importance of having talented managers in place.
Right.
He tells the story of Stan Lipsey, who saved the Buffalo News from financial ruin.
Yeah, a classic underdog story.
It is.
Shows how a great manager can make all the difference, even in a challenging industry.
That's right. It's a reminder that investing is about more than just numbers on a spreadsheet.
Right.
It's about people, and it's about finding businesses that are led by, passionate, capable individuals who are committed to creating value for their customers and their shareholders.
Okay, so Buffett has explained his thinking on insurance-regulated businesses, manufacturing, and even newspapers. But there's one big question that many Berkshire shareholders have been asking for years.
Yeah.
Where's the dividend?
Ah, yes, the great dividend debate.
Right.
This is where Buffett really breaks down his logic, using both math and plain English, to explain why he believes Berkshire's current approach is superior to paying a dividend.
It's a long explanation, but it's worth taking the time to really understand it.
It is.
He lays out this hypothetical scenario where you and he own a business together and compares two options, paying a dividend versus selling a small portion of your shares each year.
Right. And the numbers clearly favor the sell-off approach.
We do. He shows how under certain, reasonable assumptions, shareholders end up with both more cash flow and more capital appreciation over the long run by selling shares rather than receiving a dividend.
Exactly.
He also points out that dividends impose a specific cash-out policy on all shareholders,
Right.
regardless of their individual circumstances.
Right. Some shareholders might need or want that cash flow, but others might prefer to reinvest it.
Right. With the sell-off approach, each shareholder has the flexibility to choose what works best for them.
Exactly. And then there's the tax advantage.
Oh, Right.
With dividends, all of the cash you receive is taxed, whereas with the sell-off approach, you're only taxed on the gain portion of your proceeds.
Right. So from a tax perspective, it's often more advantageous to sell shares than to receive a dividend.
It can be.
Okay. I'm starting to see his point, but still it feels kind of counterintuitive to not want a dividend.
Yeah.
I mean, after all, Buffett loves collecting dividends from the companies Berkshire invests in.
He does, but he makes a clear distinction between Berkshire and those other companies.
Okay.
He argues that Berkshire has a unique ability to reinvest its earnings at high rates of return,
Right.
thanks to its diverse business portfolio and talented managers.
Okay.
So by retaining earnings and reinvesting them wisely, he believes he can create far more value for shareholders in the long run than he could by paying a dividend.
It's all about compounding, right?
Exactly.
The longer he can keep those earnings working within Berkshire, the faster they can grow.
The faster they can grow, that's the power of compounding.
And he even uses his own personal example to illustrate this point.
Right?
He's been giving away a significant portion of his Berkshire shares each year to charity. Yet his investment in the business has actually grown.
Because the value of his remaining shares has increased so much, thanks to the power of compounding.
Right. It's a powerful illustration of the long-term benefits of Berkshire's approach.
It is. It's a reminder that Buffett is playing a different game than most investors.
Right.
He's not trying to time the market or squeeze out short-term gains.
Right.
He's building an empire for the long haul, and he wants his shareholders to come along for the ride.
So even though many shareholders might, clamor for a dividend, Buffett is convinced that in the long run, they're better off if he reinvests those earnings in new opportunities.
Right.
And lets the power of compounding work its magic.
That's right. He's always thinking about what will create the most value for his shareholders over the long term.
Right.
And he's not afraid to make unpopular decisions if he believes they're in the best interests of the company.
Okay, so we've covered a lot of ground here.
We have.
What are some of the key takeaways from this letter so far? What should listeners really be paying attention to?
Well, first and foremost, it reinforces Buffett's relentless focus on intrinsic value.
Okay.
He's not just buying businesses, he's buying them at the right price with an eye toward long-term growth and profitability.
Right. He's also a master at allocating capital, right? Balancing investments in existing businesses, new acquisitions, share repurchases.
Right? Always seeking to maximize shareholder value.
And we can't forget about the people he's surrounded himself with, an incredible team of managers.
He has.
From the insurance all-stars we talked about earlier,
Right.
to the folks running the railroads and utility companies, to the unsung heroes at Berkshire's headquarters.
Absolutely. It's a team effort, and that's a big part of their success.
Beyond the financials, there are important lessons about long-term thinking patience and aligning oneself with businesses one believes in.
For sure.
He also stresses the importance of critical thinking. Don't just follow the crowd.
Right.
Do your own research, question assumptions,
Right.
and make your own decisions.
Be an independent thinker, just like Buffett.
And finally, there's this message of optimism about the American economy.
Right.
Even in 2012, when many were worried about the future, Buffett was investing billions in American businesses.
Yeah, he's a true believer in the country's long-term potential.
It's inspiring to see that kind of faith in action.
It is.
He sees value where others see only problems, and he's willing to bet big on the future of American businesses.
Right.
Well, this letter is packed with so many great insights.
It is.
So let's wrap up our deep dive by exploring Buffett's thoughts on Berkshire's corporate culture
Okay.
and the annual shareholder meeting. All right, we're back and ready to wrap up our deep dive into Warren Buffett's 2012 letter to Berkshire Hathaway shareholders. And before we went to break, we were talking about Buffett's optimism about the American economy. And, that optimism really shines through when he talks about the Berkshire Hathaway annual shareholder meeting.
Oh, yeah. He describes the meeting as a Woodstock weekend for capitalists, and you can just tell he absolutely loves it. It's a chance for him to connect directly with Berkshire shareholders and to showcase, all the amazing businesses that make up the Berkshire family.
Yeah, I've always been fascinated by these meetings. They're legendary in the investing world. Tens of thousands of people descend on Omaha, Nebraska every year just to hear Buffett and Charlie Munger answer questions for hours on end. It's incredible.
It really is. And what's so great about it is that it's not just, a dry financial presentation. It's a celebration of Berkshire Hathaway and its unique culture.
Right. Buffett talks about all the different Berkshire subsidiaries that set up booths at the meeting, showcasing their products, everything from Justin Boots to See's Candies to Dairy Queen Blizzards. There's something for everyone.
Oh, and who could forget the famous Borsheim's jewelry sale? Buffett even mentions that he'll be working as a clerk offering his crazy Warren prices.
He's got a great sense of humor.
He does.
But beyond the fun and games, the annual meeting is also a chance for shareholders to really learn directly from the Oracle of Omaha himself.
Yeah, he and Charlie Munger spend hours answering questions from the audience, covering everything from investment strategy to the economy to their outlook on specific businesses.
And they don't shy away from the tough questions either. Buffett even invites a credentialed bear on Berkshire stock to join the Q&A panel.
Oh, wow.
Now that's confidence, right? He's not afraid to have his views challenged.
That's right. He's secure in his approach, but he's also open to hearing different perspectives.
It's exactly. That intellectual humility is one of the things that makes him such a great investor. He's always learning, always adapting. And he encourages Berkshire shareholders to do the same. He doesn't pretend to have all the answers.
Nope.
Okay, so we've talked about the financial highlights of the letter, the lessons for investors, and even the excitement of the annual meeting. But there's one more thing I want to touch on. Berkshire's corporate culture. It's something that Buffett emphasizes throughout the letter, and I think it's one of the most important but often overlooked aspects of Berkshire's success.
Yeah, he describes a culture of decentralization, trust, and mutual respect. He calls the operating managers all-stars and says they run their businesses as if they were the only asset owned by their families.
It's that sense of ownership that really makes a difference. These managers aren't just clocking in and out.
No, they're not.
They're treating these businesses like their own, and that translates into long-term success.
Absolutely. He also praises the small team at headquarters, who handle a mind-boggling array of tasks, from regulatory filings to shareholder inquiries to planning the annual meeting.
It's a lot.
They do it all with incredible efficiency and dedication.
It really is remarkable. And I think it speaks to the kind of people Buffett attracts to Berkshire Hathaway.
Right.
They're not just talented, they're also incredibly loyal and committed to the company's mission.
Right. This culture of trust and loyalty is a huge competitive advantage for Berkshire.
Oh, for sure.
People want to work there, and they tend to stay for a long time.
Right.
That creates stability and continuity, which is essential for long-term success.
In a way, Berkshire Hathaway is kind of like a giant family, a very successful and well-run family.
I like that analogy, and that family atmosphere is something that Buffett clearly values.
Yeah.
He talks about how much he enjoys going to work every day, and he expresses his sincere gratitude to the entire Berkshire team that really comes through in this letter.
Well, I think that's a perfect note to end on. We've covered a lot of ground in this deep dive into Warren Buffett's 2012 shareholder letter, from the financials to the investment philosophy to the corporate culture. But as with any deep dive, there's always more to explore.
Always.
So we encourage you to check out the letter yourself, read it carefully, and see what other insights you can glean from it.
Yeah, you might even discover something we missed.
Exactly.
Yeah.
That's the beauty of it. There's always something new to learn from Warren Buffett. So until next time, keep exploring, keep learning, and keep investing in yourself and your future.
That's right.